Understanding the 35/45 rule for mortgage eligibility. The 35/45 rule is a guideline used by lenders to evaluate a borrower's ability to manage their housing costs and total debt obligations when applying for a mortgage. It refers to two key debt-to-income (DTI) ratios. This is the percentage of a borrower's gross monthly income that goes toward housing costs, including mortgage principal and interest property taxes, homeowners insurance HOA fees, if applicable. Lenders typically prefer the front-end DTI to be no more than 35% of a borrower's gross monthly income. 45% rule, back-end ratio. This measures the percentage of gross monthly income that goes toward all debt obligations, including housing costs, as above credit card payments, student loans, auto loans, other recurring debts. Lenders generally prefer the back-end DTI to be no more than 45% of gross monthly income. Example, calculation, gross monthly income, $6,000 housing costs, $1,800 other monthly debts, $1,200. Step 1. Calculate front-end DTI. Front-end DTI =, housing costs, gross monthly income, x100, front-end DTI =, 1,800 6,000ths, x100 =, 30%. Step 2. Calculate back-end DTI. Back-end DTI =, housing costs plus other debts, gross monthly income, x100. Back-end DTI =, 6,000 1,800ths plus 1,200, x100 =, 50%. Evaluation, front-end DTI, 30%. Meets the 35% rule, /N DTI, 50%. Exceeds the 45% guideline and might require debt reduction or additional income for approval. Why the 35/45 rule matters? Risk assessment. Lenders use these ratios to determine whether a borrower is over-leveraged and likely to default. Loan approval. Staying within the 35/45 thresholds improves the chances of loan approval. Borrower protection. Helps borrowers avoid overextending their finances. Tips to meet the 35/45 rule. Increase income. Boost your gross monthly income by taking on additional work or generating side income. Reduce debt. Pay down credit cards, student loans, or other obligations before applying for a mortgage. Lower housing costs. Consider a less expensive property or a larger down payment to reduce your monthly mortgage payments. Explore loan options. Programs like FHA, Virginia, or USDA loans might offer more flexible DTI requirements. The 35/45 rule is a practical framework for ensuring borrowers can manage their financial obligations while maintaining housing stability. For personalized guidance, please reach out the award-winning realtor Syed Faraz at 470-269-0420 or email spherosrealestate@gmail.com.